So we go to the notes. Okay. So first we'll be looking at cash flows or group cash flows. It's one of the most important financial statements. We have three main ones. We have the statement of comprehensive income, which is basically the profit and loss. There's some noise somewhere. Okay. Maybe just mute. Then when you want to talk to me, you can unmute. Okay, just stopped. So it was Angela. Okay. Okay. So we are looking at group cash flows. Like I said, that is one of the most important financial statement. It is in the sense that it looks at cash, and cash is king. Accountants, they can do all they want to do in the balance sheet, in the income statement, cook numbers, but the moment of truth is actually only evident in the cash flow statement. Because the cash flow statement, it is looking at the cash movements in and out, and then gives you your balance at the end of the period. It's more or less like a bank reconciliation or a bank statement, which will show the debits, which will show the credits, and it's all cash. It does not respect across a concept. You know the matching concept where I saying revenues earned must be matched against expenses incurred in earning them. Doesn't matter whether it's cash or what you have to record as profits. But with the cash flow statement, it's all about cash movements, and cash is real. So there are certain rules that we'll be looking at when you're preparing cash flow statements. One of the things that we need to make sure is that all the non-cash items should not be included in the cash flow statement. Ultimately, the numbers that you're going to find in there will be no non-cash items. I'll give you an example. In the cash flow statement, you will see, say, addition of depreciation to your operating profit. It does not mean that you have included depreciation. You have actually removed depreciation from your cash flow statement. Because if you're adding it to your profit, then all you're actually saying that your profit ideally had already charged depreciation as an expense. And being an expense, it came in as a negative. So when you say plus depreciation, so it's like those -5 plus 5, it takes it to 0. You are removing depreciation from there. If it's profit on disposal of assets, it will come into your cash flow statement as a negative. But what you're doing is that you are removing it. It's coming in as a negative because being profit in your profit and loss account, it came in as a positive. So if it's 3, you are saying it's 3 minus 3, it gives you 0. But as we look at this cash flow statement, we need maybe to try and understand what is it, how is it structured. When I look at a cash flow statement, what comes into my mind are the 3 decisions that are made in an organization. There's one, the decision on working capital, which is working capital decision, the day-to-day running, because that also you have to spend, you have to fund your day-to-day operations of the company. And in this case, it's basically the working capital, the operations of your company. Secondly, with whatever excess funds that you get from your operations, you may want to invest Then now you look at investing decisions. But this investing decision, which obviously companies have to look at and they cannot ignore, the question would be, who is going to fund this investment that we are about to make or to decide on? So you say we are going to spend so much on capex, which is capital investments. We'll spend on this, we'll do this, and all these other dreams that you have as a company, they'll fit under investing activities, because ideally that is what you want to do. You want to invest. But the question would be, who is going to fund your investments? Even in our personal lives, you will normally ask questions of that nature. If you want to buy a car, how is it going to be funded? Again, there are two ways in which you can fund your investment. It could be one, through debt or through equity. Debt, you have to go out there, if it's a bigger company, to look for huge debt, a huge debt, which is maybe senior debt. You might also have to look at subordinated debt, which is junior debt, which comes in as mezzanine. But all in all, it's debt. And you have your equity there, which is being funded from your operations. So this is how your cash flow statement is structured. It has operating activities, it has investing activities, and financing activities. It follows the logic that companies follow when they're coming up with their strategies on how they're going to finance certain things. It follows the same strategy, same structure, which you use on your day-to-day, in your day-to-day life. When you get that money from Boma Paxina every month end, first thing that you do is to manage your operations at home. Wunga, meal, and all these other necessities. If you make a mistake, you take that part of money that is coming from Boma, you take it to go and buy cement at your plot. Before you manage things there, you have the most traumatizing month, very painful month. You'll be at work, instead of actually buying reasonable food, you go and buy cassava just by that gas station outside. We see people eating cassava gracefully and happily so. I think if I'm breaking, I think it's your internet. My internet is intact. I'm able to see it here. Vaccine. So if I'm breaking, change your thing. My internet is very good, isn't it, Angela? Am I breaking even from your side, Angela? Yeah. So change your MiFi. So imagine, first thing that you have to do, whatever operations revenues that you're making from your operations, first let it fund your working capital, let it fund your day-to-day things, so that if there's excess, that is the excess that now you're going to take to invest in capital investments. But then there should be a combination of how is it going to be funded. Is it through debt? Is it through equity? This is why now in the cash flow statement you have financing activities. So we can now go back to the notes. So this cash flow statement has its own dedicated standard. It has a dedicated standard, which is IS 7. I'm saying a statement of cash flows is an additional primary statement of great value to users of financial statements for the extra information it provides. Like we said, investors would be more interested in looking at your cash flow statement than those other things that you can cook. So cash flows are much easier to understand as a concept than accounting profits because it just involves cash. It's a cash flow, it's just cash movement. But the main advantages of using cash flow accounting are as follows than accruals. One, survival of a company depends on its ability to generate cash. So cash flow accounting directs attention towards this critical issue. It's possible for a company that is highly or hugely profitable, it is actually struggling with liquidity, with cash. They may have certain stupid policies, such as coming up with a relaxed credit terms, and people are not paying. But in the income statement, as long as they are selling it, they are actually going to record it as revenue, isn't it? So to be recorded as revenue, but it's credit revenue. They are not getting any cash. Then they start now having liquidity squeeze. They are getting squeezed. So profitability does not mean a thing. So even when we say a company recorded the profit of this much, it does not mean a thing. We have to go in the cash flow statement and check how prudently cash is being managed. Because cash is king and every company depends on cash. So we are saying cash flow is more comprehensive than profit, which is dependent on accounting conventions and concepts. So if we look at profit or income statement, or just basically profit, you cannot depend on profit. Profit is not honest, because profit is a creation of dishonest people, most of the time accountants. They'll give you what profits you need. If you come to me and say, I need a profit of 50 kwacha, I'll give you that profit because I'll start manipulating certain standards. I'll find lacunas in certain standards where I should have capitalized something, I decide and expense it. Or what I should have expensed, I capitalize it so that I reduce the burden that is sitting in the income statement and create some profit. So like we are saying, it is not dependent on accounting conventions and concepts. So cash flow is more comprehensive. And the advantage with cash flow statement, as I look at the cash flow statement, I'll understand your investing appetite. I'll understand how you source funds for your investments. So to me, it's very comprehensive. Then creditors, long and short term, are more interested in an entity's ability to repay them than in its profitability. That I've said, do not trust profit. Profit is dishonesty, because we have to first look at who prepares these profit statements. So creditors should spend more time to review, analyze, independently analyze the cash flow statements for these companies, because that is where the money for their payments is going to come from, not from the profit, because the profit may show huge profits, it is not showing huge cash. So this is why we are saying creditors are more interested in an entity's ability to repay them than in its profitability. Whereas profits might indicate that cash is likely to be available, cash flow accounting is more direct with its message. Cash flow reporting provides a better means of comparing the results of different companies than traditional profit reporting. So it's easier for me to compare company A, company B, company C to company D using cash flow statements than using profits. Because if I use the income statements, there may be certain things that I'll have problems with. For example, on valuation methods, fee for leaf and all these other things, I may have very big problems, because the way a particular activity is treated by one company may be treated differently by the other company. So it will be very difficult for me to compare. But cash flow reporting, it is going to be very easy for me to compare two companies. Cash flow reporting satisfies the needs of all users, better for management, which is one. It provides the sort of information on which decisions should be taken. In management accounting, relevant cost for decision are future cash flow. Traditional profit accounting does not help with decision making. Traditional profit accounting, why it does not help in decision making, there's no cash movements there or anything of that sort. But the cash flow reporting, it will help. For example, if we realize that our working capital is actually getting a bit injured, it's being jeopardized, then we're actually saying if this working capital at the level that is going, it's narrowing, at this level, we might start failing to start funding other operations. So, what should we do during this time that the world is faced with this pandemic called COVID-19? So from the cash flow statement, we'll be able to see certain things that we can do. How do we manage our working capital? How do we manage our general operations? How do we actually dampen our appetite to invest in capital investments during this time that we're having a pandemic? So that is for the management. For shareholders and auditors, cash flow accounting can provide a satisfactory basis for stewardship accounting. Remember one thing, and we have looked at this in business analysis, where we looked at the responsibilities of the shareholders and the directors. The shareholders are ideally the owners of the company, but they may not be the most blessed in terms of having the skills to run a company. So the thing that they will do, Angela, is to humble themselves and bring a group of men and women they think are capable of running the organization. These men and women will be called the board of directors. But then this board of directors, they are the ones who will be preparing these financial statements. They will prepare the income statement, they will prepare the balance sheet, and indeed they will prepare the statement of cash flows. But the shareholders may have trust issues with the board of directors. So what they would do, in effect, what they would do is appoint their own auditors. Auditors are like Twitter handles. It should be Angela. You have done the screen. Is it the screen thing, or is your Paxina? Okay, see Paxina. No, it's Paxina. No, I'm explaining. I'm just explaining now. So the shareholders, being the owners of the company, they have trust issues with the people that they have employed in form of directors. So those board of directors, first thing they will do, they will make sure that the board itself serves their interests. They will have what they call non-executive directors as part of the board. All those are mechanisms or systems to make sure that whatever information comes from the board is very truthful, or at least truthful. But they will not end there. And Paxina are really struggling with whatever you're doing. I can see. No, there are those two squares. On the two squares, yeah, now, okay, yeah, you have come out from there now. It's fine. So, the shareholders, because they have trust issues with the board of directors, they will bring in the auditor to say, this board of directors, our people, they have prepared these financial statements. Can you help us to see whether these statements, they represent a fair view? So this is where now we come to the cash flow statements. And for shareholders and auditors, cash flow accounting can provide a satisfactory basis for stewardship accounting. Because who are the stewards of these companies? They are the board of directors. They are the stewards. So stewardship accounting, that is very key. Thirdly, for creditors and employees, their information needs will be better saved by cash flow accounting. Employees will not come up with demands on salary increments based on the profitability of the company. It should be based on the health of the cash flow statement. Unless vaziva. Cash flow forecasts are easier to prepare as well as more useful than profit forecasts. So when you are preparing this cash flow forecast, because you're looking at how much money is coming in, how much money you're going to use to pay the suppliers and all these others, how much money you're going to invest in your capital investments, how much money you're actually going to get from other sources of finance. So it's very easy to project, it's very easy to do. So cash flow accounts can be audited more easily than accounts based on the accruals concept. We said it, the accruals concept is confusing and cash flows are more easily understood. That was explained. So let's look at the aim of IS 7. What does the International Accounting Standards Board say? The aim of IS 7 is to provide information to users of financial statements about the cash flows of an entity's ability to generate cash and cash equivalents, as well as indicating the cash needs of the entity. So that is the objective of IS 7. What's the scope of these cash flow statements? And we are saying a statement of cash flows should be presented as an integral part of an entity's financial statement. It is an integral part because you have your balance sheet, you have your income statement, you have your statement of changes in equity, and you have your cash flow statement. So it's part and parcel of the whole bouquet. All types of entity can provide useful information about cash flows, as the need for cash is universal. Whatever the nature of their revenue producing activities, they also need cash. Therefore, all entities are required by the standard to produce a statement of cash flow statements, because that cash flow statement is difficult to lie, it's difficult to cheat. Obviously, we looked at the advantages of the cash flow statement, which basically they are their benefits. These are the terms that you are going to find in the cash flow statement, the definitions. One, you find cash in there. Here we are saying it comprises cash on hand and demand deposits. You have cash equivalents, which are short-term, highly liquid investments. You have cash flows, which is either inflows or outflows of cash and cash equivalents, which will be able to, which will clearly see in the statement of, in the cash flow statement, sorry. Operating activities are the principal revenue producing activities of the entity to be able to see, and investing activities, the acquisition and disposal of long-term assets will be seeing that then are financing activities. Those are the terms. So this is more of a pro forma, but let me just open something for you to just appreciate. So when you have your cash flow statement, we are going to make it a bit basic. So Statement of cash flows. So like in the exam, you should be, the structure of your cash flow statement, what you put in there, should be guided by the data that you have been given. Check what is in the balance sheet, check what is in the income statement. That is going to guide you on what should be added in your statement of cash flows. But this is the most basic. You have your operating profit. But mostly people don't get operating profit. What I've seen in companies, because they want to show, like the cash flow statement has a lot of activities, they'll look at net profit. For example, if they pick net profit here, eh? Eh? Oh, it's because you had shared at first. No, at first you were sharing. You see? So let me go there now. You see? Now you're able to see? Yeah, because you confuse things. So me, I didn't know that you. Yeah. So then you're looking at statement of cash. Oh. So you're looking at statement of cash flows. So you're saying in some companies they'll start with their net profit. Just go down there. They'll do their net profit. So from this, maybe here I do like this. Kwacha. Yeah, kwacha as well. So they'll start with their net profit. So if they start with their net profit down, the first thing that they would want to do is to have some form of EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization, because your EBITDA is basically your operating profit. So that's the aim that they'll be doing here. So they have to start removing certain things that don't make sense. One of the things that they'll remove is depreciation. So they'll say add depreciation. By adding depreciation, they are removing depreciation. Do you understand this part? Or you need further explanation? So by adding depreciation, we are removing depreciation for cash flow. You understand that? Then there will be things like add, or should I say less? For example, if you had profit on disposal, so profit on disposal, they remove that. There will be things such as, because in the net profit there was interest and tax there. So if those interest, all they are actually doing, they want to remove interest. Interest comes as an expense, so they'll say add interest. Then say add taxation. So whatever figures that they have, here the heading please to be operating activities. So all the numbers they'll have, they'll bring them here, for example. Then they'll have now issues on changes in working capital. So under changes in working capital, they'll have increase, stroke, decrease in inventory. Let me explain this first. Any increase in assets, any increase in assets is a cash outflow. Any increase in liabilities is a cash inflow. So when you see an increase in inventory, just know that is a cash outflow. A decrease, a cash outflow. An increase in liabilities is a cash inflow. So if you see an increase in assets is a cash outflow, whereas an increase in liabilities is a cash outflow. Just as a matter of principle, you start from there. Before you start debating whether it was a cash item, whatever, just first, just as a matter of principle, you start from there. So here, if we say there has been an increase in inventory, what it means is that it is going to be an outflow, whereas a decrease in inventory is going to be an inflow. So same with increase in trade receivables, it's going to be like this. Then here, we'll do like this. In payables. So once we have these numbers, this is what will come here as whether to be cash inflow or cash outflow. So they have these numbers here. Then now, here we'll have things like interest paid and taxation paid, tax paid. Which I'll bring here as negative, sorry, which will sit like this. And it will come this side. So this is now what will be called as cash generated from operating activities. Whatever you're going to have here. Assume to be cash generated. Or you can say cash inflow, cash outflow from operating activities. You can leave this generated here. Maybe it is going to deceive you. You can just say cash flow, cash inflow, cash outflow from operating activities per manner. So here the understanding is whatever cash you have after you have exhausted, because this is your net, maybe let me just call it nicely, net cash inflow, cash outflow. So that I don't confuse you. It's my responsibility not to confuse you. that's my responsibility. So net cash inflow or outflow from operating activities. So whatever funds that you have here or you don't have, but you want to invest, you need to actually look at first your investing activities. So under investing activities, you have to invest in maybe capex. I'll just write like this: capital investments. This could be in your property, plant and equipment. Depending on how your question is, you are going to write it as is. Don't worry. Here you might want to dispose of PPE, property, plant and equipment. So you may have these two. Or you might actually want to acquire maybe a subsidiary. You might want to acquire okay, let me just reduce it so that you're able to see. So here it could be business acquisition. There it could be sale of business. This business acquisition could be through a subsidiary, it could be through a joint venture, it could be just an associate, so you have all these. So your capex, obviously, your capex is going to be a negative. Your capex is going to be your negative, like this. Your disposal is going to be your business acquisition, negative. Copy sale of business this. You may have numbers of this kind. So these numbers will sit there. This will be your net cash inflow stroke outflow from investing activities. From investing activities. I guess you'll be more tidier than I am. So you have those figures which would come in that form. Then you have the thing there. From investing activities, you could now go to financing, because you have to finance these activities. So these activities can be financed from your operating activities, from your other sources of financing, such as equity, where you go on a stock market, or you can finance through debt. So you go to financing activities. Too much stress. Feeling sleepy, yeah? So we got financing activities. Once we are done with the theory, so that tomorrow now we can start looking at computations. I'm telling you, I'm feeling sleepy, not so well. So under I started at I know the first class was at 10, but obviously preparations and all that started there. But yesterday I was with the guys' financial modeling class, so I went up to about 23, or if not midnight, up to midnight. Guys, I'm feeling like a variant, man. So let's move on. Financing activities. Other financing activities to be issues, which you can say, maybe you can say share issue. This comes as a cash inflow, but this is through equity. This could also be maybe through debt. We can call it debt procurement. We'll find a better term at some point. Here you could have also debt payment. So debt payment, which will be a negative. Or they call debt repayment, sorry, debt repayment. Let's use the right terms. Folks, debt repayment. Here, though the standard, it does not dictate to you where you should take your dividends paid. Dividends paid, they can go under operating activities or financing activities. Because for you to pay dividends, it means there's someone who has invested in your company, isn't it? And you're using that. For these who are, once you issue shares, what will come out from issuing of these shares? They will demand the dividends. So dividends will come here as dividends paid. But on dividends paid, let me just put this remark. The standard is not too prescriptive. You can either plug it under operating activities or financing. So the standard is not very prescriptive here. So you can either have it under operating activities or under financing activities. But what is also important, interest received should be here, and I'll explain. For you to have received the interest, it means that you invested, isn't it? For you to have paid dividends, it means someone gave you money. This is why dividend paid finds itself here. Interest received finds itself under operating activities or under investing activities. You have seen two much still, okay? So let's move on. So once you have these numbers, guys, they'll come this side, copy. Which will be cash inflow, or I'll just fix this, copy, from financing activities. So once you have these numbers, this will be increase in cash. This will be increase or decrease in cash and cash equivalents. So come here. Basically this. Then you have your balance brought down, cash balance brought down, which comes here. Here I'm assuming that you have cash as a company. So you add it to, yeah. So what you get now will be your cash carried down or closing cash, like this. So it doesn't matter whether it's a group cash flow, it's a single company and a single entity. This will be the format. This will be the format. This one here, yes, in cash and cash equivalent. Okay, understood? Yes, for the previous year. So here, if you are looking at this, this will be, say, for 2019. Then here, it will be, say, 2020, closing balance. That is how it works. And even this number here, it goes in the balance sheet. This number is coming from the balance sheet. You get that? Very good. So it's all these things here. You know, you just pick one or two things. Dividend paid to NCI, whatever. So you have to follow this. They just finished the theory so that tomorrow we start on. So I'm saying I7 requires statements of cash flows to report cash flows during the period classified by operating, investing, and financing activities. These we have actually looked at. There are different ways of reporting cash flows. There's a direct method and the indirect method. Apparently, the indirect method is the one that is so common. It's easier to do because the direct method, there's so much work that is involved in preparing the direct method in the company. When you are using direct method, it's very, very tedious. You have to go to treasury, you ask whatever transactions have been going through and all these other things. So it takes a bit of some time. So the standards is a more leaned to indirect method. The method that I've shown you there is an indirect method, which just been explained, which is these things, which we have already looked at. Huh? You remember we looked at these things. I explained why certain items are added or subtracted. On depreciation, I told you, is not a cash expense, but is deducted and arriving at a profit figure in the statement of comprehensive income. It makes sense, therefore, to eliminate it by adding it back. So these are just explanations which I had already told you. So I say the direct method is encouraged where the necessary information is not too costly to obtain, like I told you, but it is very costly to do, especially for these big companies. They would rather go for indirect method. But IS7 does not require it and therefore favors the indirect method. So IS7 favors indirect method. In practice, therefore, the direct method is rarely used. There are very few companies that will sit and want to use the direct method because it's expensive. It's expensive. It's a very big problem, actually. It is not obvious that I7 is right in favoring the indirect method. Banks, they will rather, when they're asking for your cash flows, they'll rather see your cash flows in the direct method form than in the indirect method. This is my view, and I'm stating it in these notes. I've put it there. So throughout my years in the corporate world, specifically in the area of financial modeling, I've come to recognize that lending institutions prefer the direct method, and most of the cash flow forecasts have developed for the firms use direct method. But International Accounting Standards Board, they're more on the indirect method because I think it's easier. It's less costly. We'll be looking at this thing. So tomorrow we'll start now on looking at the tier accounts, on group accounts. These are the things that we'll be looking at. I can take a nap a bit, 15:30, I'll make a small class, but even that one, it will be just under 1 hour maybe. Angela, you can go and sleep. Vaccina, you can continue watching in Indigo. She just needs to go and sleep. Thank you so much. So I don't know what time do we have we agreed, have we firmed up our time? Yeah, decide 10 hours is all right. So that it gives you time to sleep. Okay. Okay, thanks. Bye bye.